And now, without any further delay, let's begin today's event. Once again, are you ready for ISDA SIMM? Today's presenters are David Ezra, Fixed Income and Risk Management of ISDA Services, Liam Huxley, Founder and CEO of Cassini Systems, and Trevor Negus, Product Manager, SmartStream Technologies. And at this time, I'd like to introduce our first presenter, and that is David Ezra. David, the floor is now yours.
Thank you very much. Good morning, good afternoon, everyone. Thank you for joining today's session. Thank you to Liam and Trevor for being with us today as well. So today we'll cover the impact of bilateral IM and uncleared margin rules. We'll present ICE offering in that space for data, analytics, calculation. We'll review the best practices for firms coming into scope, how people can use the $50 million threshold at their advantage. We'll talk about optimization of IM, in particular how do you put bilateral IM versus going at the clearinghouse. And we'll discuss as well some aspects of the collateral management workflow. Let's start with some warm-up questions. What in bilateral initial margin phase is your firm expected to fall into? Phase 5, 6, already live phase 1 to 4, don't know. Let's look at our answers. So it seems like we've got a good share of the audience in scope for the SEP 20 and SEP 2021 phases. So we'll discuss about this in a second. Other question, what stage of project implementation are you in for uncleared margin rules and ISDA SIMM? So researching the situation, creating an implementation plan and estimating a budget. You've already completed the implementation and the budget has been allocated, implementation in progress, complete, don't know. Let's answer. Wait a bit. Look at our answer. Okay, so good share of the audience working on a plan, estimating a budget. Some people researching the situation. Implementation in progress already for more than 10% of participants. Many participants still don't know much apparently about this, how they're going to prepare for this. So let's discuss in more details what are uncleared margin rules and ISDA SIMM and how we can help you. So just for the background, we after the 2008 financial crisis, started with cleared products, and then the bilateral space was done on an independent amount-based model where people use scheduled approach with sometimes a high percentage of notional, not necessarily benefiting from netting. And we are now working, in this framework where the industry is pushing for a standardized model and approach to calculate this bilateral margin and to streamline and automate the workflow. First phases, so the big swap dealers, the big banks, people with large notional amount in bilateral derivatives implement this, and today this community is exchanging margin. We are now entering phase 5 and 6 with a lot more accounting scope for this implementation. With for phase 5, like more than 100 accounts with more than 50 billion above the 50 billion threshold. Phase 6. More than 1,000 accounts above the 8 billion threshold. The US firms were in a regulatory calculation period over the summer. European firms are all working on this now. We're preparing for first half 2020 implementation. In APAC, Australia, Hong Kong, Singapore, Japan, South Korea, they're all going for this. Timeline similar to the US and Europe. Other APAC countries may apply the approach on a best practice basis. what's behind this methodology? Really, it's an approach where you calculate a value at risk using, the threat sensitivities at the portfolio level. The approach really is trying to propose a model where calculations can be scaled and you don't have issues of scaling because of the complexity of the calculation. So using sensitivity is very useful for that. Remember, like variation margin covers you for what happened. Initial margin covers you for what's going to happen in the next 10 days with the counterparty defaults. So one of the things I remember from the trading floor is when you have a big dealer defaulting, everyone is rushing to replace their swaps and their CDS, and that's what this is helping to hedge. So when you calculate this amount, you collateralize on a daily basis. Then there's less risk in the financial system, and people are more comfortable trading these derivative products. So the model really consists of calculation of risk sensitivities, then weighting the different risk factors in your book according to where the risk is concentrated, which types of instruments, and then the weight and sensitivities are also aggregated via correlation matrices. What's required to do those calculations? Obviously, market data. Ongoing market data, you need good market data. So if you do that pre-trade, you even need like live market data. So we'll talk about this later on in the presentation. For people who need to backtest or do some various stress tests as well on the model, compare it to a VAR model. You will also need to source historical data, and obviously beyond data, you need analytics, good analytics to calculate these sensitivities that are the key inputs in the margin calculation model. Some of the challenges we have seen so far, obviously we are talking now in particular to European clients. We worked with some phase 3 and phase 4 banks for the data aspect, because these larger institutions had their analytics but needed really to source data, ongoing and historical data to backtest and validate the model. So some of the challenges we have seen over these work streams, for instance, some private banks struggle to price sensitivities on equity and FX barrier options, complex products. Some banks in phase 4 that are already in production now with this encounter issues internally with some of their vendors because of the exotic products again. And let's not forget that the bilateral space is pretty intense in terms of exotic. Obviously, you're not talking about the vanilla IR and CD products that are already clear now, but you're talking about some products that are a bit more complex, where there's not so much transparency in the market data. We also saw some large banks with a need to source rare data sets like rates, credit volatility, credit correlation data. So these are really some challenges we've seen recently where we are proposing our services. Models need to be validated, not by everyone, but the larger accounts for sure. So various states, compare the model to VAR, we discuss it. Dynamic monitoring where you compare the daily P&L with the 1 day ISDA SIMM. So 1 day ISDA SIMM is a variation of the 10-day version with different parameters. Just a question for people on the phone. How will you calculate the bilateral margin? Will you do it in-house, or will you use a vendor? Will you outsource the collateral workflow to a service provider? Don't know. Okay, so a good representation among participants will use a vendor to see results. Some people don't know, so some people are still working on their plan or trying to understand a bit better what is this bilateral margin about. What can we help you to implement this this margin calculation? Just some background on ISDA services. You heard a lot of talks recently about exchanges buying data assets. It's a trade we did at ICE more than 5 years ago. We've invested almost $10 billion acquiring data assets, and we are today a big provider of data across all asset classes in the OTC space. We value millions of lines intraday and upday on vanilla and complex OTC products. And this introduction allows me to explain what are the key pillars of our ISDA SIMM offering. It's not a space where we are just jumping in with no expertise. It's a space where we've been actually 15 years. It's just a continuity of our valuation data and analytics business. So what we propose really is first calculation services for people who need the full assistance there. Like again, we're talking about exotic products, complex products, so calculation of risk sensitivities, calculation of the margin to collect, margin to post. For people who want to do the full and who are ready at their own institution to transfer the full valuation workflow as well. So propose a framework where VM, IM, all this calculation can happen in the same place using the same market data, so everything is synchronized. That's the core pillar of our proposition. For people who have their own analytics, we can obviously propose market data, so historical data, ongoing data across all asset classes, volatility surfaces, forward curves, anything really dividends. It's our bread and butter, and we are a big provider of OTC derivatives data within the marketplace, both in real time, end of day, at cutoff. For people, the larger firms, we need to go into these tests. These tests are quite intense, with the ask to compare, to look at how the margin covers you for 10-day P&L, realized P&L moves. So I think provide all the analytics with the historical data integrated to look at this test is also one of one product we are pushing. We also have so until now I spoke about data analytics, and we have a software, actually a UI as well, that's very user friendly, where you can book your portfolio per CSA and run this calculation on screen and offer the UI for people working on this initiative at your firm. So that's the fourth pillar really of our offering. In the interest of time, and I wanna give some time as well to Trevor and to Liam to speak. So I'm gonna skip on this slide because I think we already covered it. Just to have a look how these calculations happen. The portfolio is uploaded. You've got the calculation of calculated sensitivities and the translation of that into a CRIF file. So this is this green template that you see. This is how you would view it, but obviously something we deliver on report on FTP. But this gives you the calculation of ISDA SIMM sensitivities that are an input to the ISDA SIMM model, and that's available on report in a CRIF format. This is how the calculation of margin looks like with your counterparties, the margin to collect and to post. Just to mention an important thing that we are doing at ICE as well. This is coming from our business ICE benchmark administration. This is about giving a consensus product to the industry, how to bucket underlying assets in the credit and equity market. Because you need to map these ISINs and the equity underliers to market sectors and risk ratings are obviously attributed according to this mapping. Because all the banks do not necessarily have the same representation of this mapping, we offer a consensus service that's becoming a standard in this ISDA calculation model, and that's done as well within our ICE benchmark administration business. So it's also the fifth pillar really of our offering. So I'm going to skip on this slide and introduce Liam, who's going to speak about the best practices for this implementation and give us an overview of the Cassini offering. Liam?
Thank you. So, hi everyone, thanks for joining today. I'm Liam Huxley, the CEO of Cassini. Just a very quick background just to explain who we are. So, Cassini was founded with the principle of providing a new kind of tool set with the initial overarching vision of providing a trader or portfolio manager at pre-trade time the full lifetime cost of their trade. So if we think about what that actually means, it implies being able to understand all of the post-trade costs and constraints that will affect those trades after execution. So in building that, the answer to that question, we built out a complete platform, and really the way we think about Cassini now is that Cassini is of course, the margin analytics platform. And we really kind of created a new type of analytics toolkit here, a solution set that didn't really exist in the market prior to Cassini. The overarching way to think about what Cassini does is that we calculate, analyze, and reduce your margin and your post-trade costs. As you can see from the diagram on the right-hand side of the screen, there's a lot of different kind of modules to the platform now, and we cover the whole life cycle from pre-trade, post-trade. What we call post-trade, we think about as sort of post-execution, intraday types of tools, to end of day. Without going through all of those in detail, they broadly fall into three kind of functional buckets. Pre-trade are all a different range of pre-trade analytics that include margin estimation and comparison between dealers or clearing brokers, lifetime cost analysis, which includes understanding all of your collateral requirements over the whole holding period of the trade, applying your funding rules to that depending on your internal model, fees, broker fees, internal fees, etc. Post-trade we think about as transparency, so surfacing information about margin and collateral costs into the front and the middle office. So we'll talk a bit more about some of these tools because they directly affect UMR and SIMM shortly, but attribution, margin analytics, day-on-day movement, and some optimization tools there around compression and porting tools. And then end-of-day tools for the platform really fit into end-of-day processes such as margin calculation, collateral optimization, and those kind of areas. So a very broad suite of products, but really falling into covering all derivative asset classes. But specifically, obviously today we're talking about UMR, and UMR and SIMM is a part of what we do, and it's obviously a key part of the regulatory mandate that's coming down the line. But the way that we think about UMR really is in keeping with our original vision, is that UMR, as a set of regulations, create both an operational obligation, but also a firm-wide financial obligation. The operational obligations obviously mean that you have to be able to calculate the initial margin using SIMM or grid or combination. You have to be able to operationally process two-way margin. You have to have all of the segregated collateral accounts and all of that sort of operational toolkit in place. So that's where a lot of people's energy is focused initially. But you equally have the financial obligation on your whole firm, where you have to think about the overall firm-wide cost of UMR. So what is the impact to you as a firm of having this new additional collateral obligation? What is the impact in terms of liquidity and being able to maybe be constrained from trading through certain dealers or certain trading routes? So it creates a new set of challenges, which we can kind of think of in terms of best execution. UMR and the cost of collateral changes what the understanding of best X really means. Overall incentives for P&L on your trading books to reduce your cost of carry, and the challenge of managing and ensuring that you can control all your collateral liquidity and not have collateral issues actually constrain or limit your trading options. So when we then move forward and think about how these challenges translate into what firms should be doing and what best practices are, we can learn a lot from really phase 4. As Cassini, we've worked with phase 4 buy-side firms falling into scope of UMR. And really the challenges of phase 4 private stakes are very different to those of phase 1, 2, and 3 in the dealer community. The first thing is to think about is that initial margin has to be looked at as part of the whole end-to-end trade control process. When you're thinking about trade, you've got the operational controls, you've got risk controls. You now also need to think about your collateral and funding controls. And that applies to all of your collateralized books, but particularly here, the bilateral trade. Another key component is that because the use of capital is now becoming that much more significant in terms of bilateral trading, you need to have practices and policies in-house for attributing your use of collateral down to your funds, your strategies, your trading books. Also, as I just mentioned, best execution. You need to be able to include the cost of carry as a factor in your execution decisions. Just executing, putting a trade out for quote and executing on the best available quote is not going to get you the overall true best ex. And this is reflected in other regulations such as MiFID II. Other practices the firms need to think about include things like forecasting and what-if scenarios. And this is kind of key. Calculating SIMM for your initial margin as an overnight process in order to meet your posting obligations is kind of your minimum position. To be smart about managing your margin and reducing its impact, you need to be able to run forecasting models, what-if scenarios on your trade and your portfolio growth, and also then bring that back into pre-trade. A couple of other points, because I'll move on and touch on these in more detail in a minute, are using other trading strategies to actually then optimize and reduce margin. So that goes away from just pure pre-trade comparison, but actually thinking about what types of assets you trade. And also maximizing the $50 million threshold. We could talk all day about the $50 million threshold, but essentially there's a lot of opportunity there to be smart about making the best use of that and minimizing your overall margin focus. So just to look at a couple of those strategies in slightly more depth, and we'll tick through them fairly quickly, and we'll obviously be able to answer any of your queries in more depth at the end of this. But best execution, as I said, MiFID II extended the full definition of what best ex means in terms of having to include other correlated costs, not just execution quotes. And what that really means is that we need to think about the overall carry cost of a trade. The carry cost is going to be dependent upon the margin level of the trade, the type of collateral you need to post against that trade, the availability of eligible collateral you have in-house, the way that you think about attributing opportunity cost of using those collateral assets, net cost of any cash that you're posting, and also any other fees. You may have operational fees, you may have clearing and broker or dealer related fees. All of those factors need to be taken into consideration to come up with a true overall cost of carry. If we think about reducing margin, now what that means, if you think about, take one step further back. As a firm, you think about optimization. Most people take that to mean optimizing collateral. But if you can optimize your margin from pre-trade through post-trade, you obviously minimize the collateral you have to post and you reduce the problem of collateral optimization. So what that really means is thinking about what the cost of margin is, what the relative margin levels will be, and then using different strategies and tools to ensure that you can reduce that to the lowest possible level. One key way is obviously pre-trade analysis, but there are other strategies which I'll come back to in a minute, thinking about trading into different product types, so using clear trades where eligible instead of bilateral, which would ensure that you can still trade equivalent risk, but with a lower margin level. Bilateral clear trades will generally be lower margin levels than SIM. That's not true across the board, and it is very dependent on the portfolio structure, but as a general rule of thumb, that's the case. Strategic backloading is a good concept that we talk about with our clients quite a lot. And the key here is that as SIM comes into scope, whether you're in phase 5 or phase 6, you only are regulatory obliged to bring new trading activity into your SIM CSA. You have a choice, and you can negotiate with your counterparty whether you also include your legacy trades. But strategic backloading is an option where you can choose to selectively novate trades across from your legacy CSA, which may have just IA or potentially no margin, into your SIM compliant CSA, where it's going to provide a risk offset and lower SIM. And that's kind of tool and analysis that you should be doing in-house on a regular basis, whether that's monthly or whatever suits your portfolio. Other optimization techniques, we talk about other kind of novation and compression techniques, and pre-trade margin and broker selections. The key with the pre-trade analysis is to run a like-for-like comparison of the trades that you want to execute against the eligible dealers, and understand firstly whether you have sufficient collateral to be able to trade with them all, where that will sit in terms of your margin thresholds and whether you'll be over or under, and what the comparative carry cost will be. A couple of other practices we mentioned: attribution. Attribution is a key control. There are two forms of attribution that are important. One is prorating and attributing the margin and the cost of margin back to the individual trades or the individual trading books. Another model, which is more of a risk control, is what we call marginal margin, which is understanding the potential impact of closing out or unwinding trades in the portfolio, where that may have an unintended consequence of removing risk offset and therefore creating an additional margin requirement. That is something that each individual PM and trader will not probably be incentivized to have focus on, but should be a middle office treasury control. Attribution also, in true best practice, would go another step further, and not just thinking about attribution of the initial margin itself, but going back to the post-lifetime cost concept and attributing back fees and carry costs and funding costs back to the individual traders. So one other concept I mentioned was forecasting. This is, again, is very important control for firms that are coming into scope for UMR in phase 5 or phase 6. Because, as I said, only new activity is obligated to be UMR compliant. But what that means is that over time, the book that's under your UMR CSA will start to build up. And you may find that initially you're under the 50 million posting threshold and therefore not posting any margin, but will need to start to post when the book starts to break that threshold. So using what-if analysis and longer-term forecasting to understand how your trading is going to change and where you might potentially reallocate trades to control and reduce that margin is become a key control. I'm going to skip through some of these things. There's a lot more we can say about them, but in the interest of time, there's a lot of sophistication here, and it really comes down to having a tool set which allows you to do what-if scenarios that can be tailored to your fund needs. So one last key point I just wanted to mention, which is a key question we hear a lot from firms all across the street around this phase 5 to phase 6, is the $50 million exchange threshold. So the key with this is that you don't have to post any margin if your total margin requirement is going to be under the $50 million. A couple of key things to mention on that. Firstly, if you can stay below that 50, you don't have to have the custodian accounts and the operational readiness. So there is a huge extra motivation to try and stay under that level, not just in your posting margin, but you save the operational costs. The 50 million, however, may often be lower than that. 50 million, your dealers may want a 35 or 40 million threshold to ensure that they stay safely and in control. If you exceed the 50 million, you cannot continue trading on that portfolio unless it's margin reducing trades. So there's a lot of good reasons to stay and monitor it and stay in control. We've got one quick poll on that point, which is basically, do you as a firm know if you have any relationships currently in place, these relationships with dealers that will breach the $50 million threshold? So simple yes, no, or don't know at this point. I think it's sufficient. Yeah, so we'll just have a look at how we're polling on that question. Okay, 50% saying yes, and I think that's interesting. We're seeing lots of firms that have breaching the threshold, which is obviously what we're seeing here today. We also see a lot of firms that have below threshold levels that need to monitor and control, and that's the key point here, is that where you have a 50 million threshold and you have the potential to control and stay below that, you really need to have strong monitoring and internal trading controls to manage that threshold. And that goes back to pre-trade controls, it goes back to active management, and it also goes back to using the idea of having a diversified set of dealers and diversified set of eligible TSAs. The more eligible TSAs to have in place, the greater the overall aggregate margin exposure you can run, is the sum of all your 50 million thresholds. So that gives you a good incentive to have internal control in place that allow you to see those opportunities. Just to wrap up, and I'm kind of out of time on this section, so we won't go through all of these slides. Essentially what we've just got here are a few sort of samples from a case study that we have around how some of these optimization best practices have been used by phase 4 firms. And it's really just indicating how you can apply different tools such as trading out of bilateral into cleared, broadening your broker selection, and using strategic backloading to use and control and reduce margin over time. So this last slide also is a conclusion from that case study. I won't spend time on this either because we're running out of time, but the overall conclusion, I would say, for a summary of all these key points, is that what we've seen from phase 4 firms and early adopters of phase 5 is there's a lot of best practice tools which you need to put in place which give you transparency and control in the front and the middle office over UMR and your overall margin exposure. And on that, I will hand over to Trevor to take it on the collateral management sector.
Thank you very much, Liam. So yes, I'm going to talk about, so we've talked principally about the risk analytics. I'm going to talk more about the operational, legal and collateral management challenges around UMR. So just by way of introduction, you need to work out whether you need to be operationally ready for UMR, and that's based on two factors really. One, on whether you've breached your ANA, your aggregate outstanding notional. If you have, then you are in scope 5 and 6, judging by the polls earlier. Many of you know already which phase you're likely to be in. But of course, once you've established that fact, you need to communicate that or disclose that with your counterpart firms. And given the numbers that are involved, the sheer numbers of clients involved in 5 and 6, phases 5 and 6, that's going to be an onerous task and something that people need to be thinking about well ahead of the September deadline. So once you've established that you are, in scope from an ANA perspective, it's then a question of whether you're breaching the 50 million threshold, and you may well not be anyway, just as naturally because of your trading, particularly given that many FX transactions, physically delivered transactions in the FX market are not included in the calculation, but they are in your ANA, so you may well be below because of that. Equally, because of the strategies that Cassini and Liam talked about in terms of reducing your IM SIMM figure will mean that you potentially could be below that 50 million. So does that mean that you're off the hook? Well, potentially, yes, if you're well below, but you may not be. You may be nudging up close. And so, as Liam said, if you're approaching the 50 million and then you do breach it, then you won't be able to do any more trading unless it's distributing. So there is you're not completely off the hook if you're below the 50 million. And further to that, of course, we can't all sit back and assume that we are going to be given a 50 million threshold by our brokers. It may well be 40 or 35 million. So that also needs to be considered. And as well as that, we need to think about, or you need to be thinking about, what your counterpart firms are going to be using to calculate IM, because under the SIMM, you may well be reducing your IM, but if your counterpart and you agree to use the schedule approach, then your IM requirement is going to be significantly higher, and that may end up pushing you over that 50 million. So you need to potentially be monitoring that. And as Liam said, there is a Cassini SIMM monitoring tool to check whether you are approaching your threshold, which is obviously very useful. But as you approach that, you need to be getting your operational structures in place, because those are not things that necessarily happen very quickly. So, first of all, if we move on to the next slide, there is the documentation challenge around initial margin. So once you do breach that 50 million, then you need to have CSAs in place. It's no good negotiating that after the event. That has to be done well in advance. And given the number of counterparties in scope, 20 in over the next couple of years, those 350 next year, 750 the year after, then there's a lot of agreements that need to be negotiated. And estimates put that around 9,500 trading relationships which need new CSAs. So that is a big and onerous task for the legal department, not something that necessarily happens quickly. So in negotiating, you have to obviously cover off things like what transactions are going to be covered in the agreement, what are your margin terms, so your minimum transfer amount, that kind of thing, what interest rates are you going to pay on cash that is posted, and also what settlement instructions that you need to put in place for your collateral movement. As well as that, there is the 50 million threshold that Liam spoke about. That needs to be negotiated into the document, but importantly, that's not something that is given on individual CSAs. It's done at group level. So if you're trading with a large broker, it's across the whole group level, or if you've got a fund that has multiple managers, then that 50 million has to be shared. So it may not be done. It may not be obvious. It may be significantly less on the relationship that you have. The other big thing that needs to be negotiated is the whole eligible collateral schedules. Obviously, under initial margin, principally that will be settled in the form of securities. So negotiating what collateral you are willing to accept and your counterparty is willing to accept is a potentially long and drawn-out process. The next thing to consider is whether your counterparty is going to be using the SIMM or the grid, so that needs to be ironed out as well. And finally, how is the document going to be negotiated? I'm sure many of you will negotiate by sending the document back and forth, but there are, of course, electronic negotiation tools out there like ISDA Create. It may well be that brokers are requiring you to get set up to negotiate via that mechanism. So there's a whole raft of issues to consider from a documentation perspective ahead of you coming into Go. So moving on to the next slide, what collateral management functionality do I need? What operational capacity and IT do I need to put in place to manage my day-to-day collateral process? Obviously, once you've breached that 50 million threshold for IM, you'll need to post collateral back and forth. So you'll need a warehouse for your CSAs to be set up in, and that's for both your initial margin and your variation margin CSAs, and you'll want arguably all of that in the one place. So your legacy VM agreement, your legacy IM agreement, so that you can monitor your IM and your VM all in one place. You need some method to issue your margin calls, so you need to be connected up to your email servers, your SMTP servers, or potentially connected up to a electronic messaging system for messaging calls like Acadia Soft Messaging. All of this needs to be considered. As well as that, when you are posting collateral back and forth to settle initial margin, we know that initial margin is principally going to be settled in the form of securities, so we need to have those eligibility structures set up, which will also include things like what types of securities, what ratings of securities, what maturity types of securities am I willing to accept, and equally what haircuts am I going to apply to those different asset classes. Equally, there are certainly in Europe regulatory rules around concentration, so how much of a particular type of collateral can you hold from a particular jurisdiction or from a particular issuer. All of those concentration rules need to be monitored when you're booking collateral and on an ongoing day-to-day basis. Equally, there is the concept of wrong-way risk, so you have to monitor how much, whether you are able to take collateral from a particular client. So if a client has issued a security, you can't take that collateral because it will breach wrong-way risk, or if it's related to the issuer, because of the correlation, you can't accept that. So all of that has to be checked. There's also how you monitor your regulatory IM versus non-regulatory IA. That is obviously complexity, which is now a bigger issue for phase 5 and 6 firms, where it wasn't in the early phases. Equally, you have to manage your dispute process. So there is a reconciliation process. If you're disputing on a margin call, you need to be able to reconcile your trade portfolios, reconcile the sensitivity inputs into the SIM calculation, reconcile your SIM numbers, and have some sort of dispute resolution process. So all of that needs to be set up and configured as well as reporting. So you need to be reporting not only internally but also potentially externally as well. And then there's the thinking around whether you are going to build a collateral management system, or whether you're going to engage a vendor for that, or whether you're going to get outsourced to service providers. All these things need to be sorted out well ahead of when you are in scope. If you're going with a vendor, are you going to go with an on-premise deployment, or are you going for a cloud deployment? So moving on, as I'm sure all of you are aware, initial margin collateral has to be held in a segregated account, so it must be held in a way that protects each party from the other's insolvency risk. So it's not like variation margin where you post collateral to your counterparty to their account. It has to go to a independent third-party account. So there's that whole process set up. You have to negotiate bilateral control agreements or something similar with your counterparty and with your custodian to hold that collateral. And estimates put that figure around 19,000 custody agreements over the next couple of years that need to be signed, and that's a massive undertaking. to handle in the coming months. If you're you also have to look at the concept of know your client, for your client's custodian. So it's not someone that you've dealt with and your client says, well, we're going to use this custodian, then you need to potentially start that whole process around setting up the account, but also understanding who that custodian is. So the big decision is how you're going to operate with this. Now, in phases 1 to 3, the standard model was use tri-party arrangement. So that is essentially allowing or delegating collateral selection process to a tri-party agent, so one of the big tri-party custodians like Euroclear or Bank of New York. So what you do is agree the IM figure and notify the tri-party, and then they take care of the collateral selection by going into your long box and allocating collateral to your counterparty, and that could be refreshed multiple times through the day and can be settled intraday. Question is, if you go with that approach, do you have to check that the tri-party is allocating correctly? Many firms that we've dealt with in the early phases have decided that what they can outsource to a tri-party, they do have to check that the tri-party agent is allocating based on the correct, under the eligibility structure within the CSA and the concentration limits and the wrong way rescue limits are all abided to. But what we're seeing with phase 5 and 6 firms is potentially, for those lower volume portfolios, there is this third-party approach. So this is where you manage the collateral. You don't hand it off to the third-party agents to manage. They actually, you actually have to instruct and select the collateral, which means that you do have to actively monitor the eligibility and the concentration limits and the wrong way risk limits. So whether you adopt either approach, there is an undertaking there in terms of negotiating those trilateral accounts. So moving on, there's as I said, it's mainly collateral, security collateral, and there's going to be a huge requirement for extra collateral come 2021, and essentially 1.5 billion extra collateral, and that needs to be managed and optimized actively. So someone needs to be looking at the eligibility and concentration rules, and there are lots of new types of collateral that are becoming more regularly used. We've seen, obviously many firms who historically have just used cash are having to move into using securities, but also things like money market funds and UCITS funds are also eligible. And if you don't have that relevant collateral at the time that you're posting, you'll need to be thinking about transformation services like transferring cash into securities via repo or securities lending. And again, how do you optimize that collateral? That is important. Do you go for a simple ladder or approach of just ranking your collateral, or do you go with a linear programming approach where you're looking at your requirements, the eligibility, and the cost of that collateral and optimizing that way? And I know Cassini can offer solutions in that domain as well. So moving on, and I appreciate we're running a bit short on time here, so I'm not going to focus too heavily on the next few slides, but where we do see that, did I do that? We do see that people are wanting to automate their collateral management process as much as possible, and we can certainly help with that automation process, so it's become sort of an exception-based approach rather than a manual approach. We have a whole suite of solutions around the collateral process, around processing your margin calls, reconciling your margin calls, reporting on those margin calls, managing your inventory, and all of that can be deployed either on-premise or via the cloud, and we have both a PIC client and a web interface for you to access that. So I just want to finish up by sort of pulling all of our three presentations together. So in terms of the IM infrastructure, so we have Cassini off to the left-hand side there, looking at the pre-trade, best execution and lifetime cost analytics, so trying to look at the cheapest place for you to do the trade, optimizing your margin and monitoring your SIM as you're approaching that 50 million, attributing the cost to that margin as well. Then you have the ICE sitting there supplying the market data, all of the market data that's required for your SIM calculation. They can calculate your variation margin, but also on the initial margin side, calculate your sensitivities, generate the CRIS file, and calculate that ICE SIM result and post off the VM call and the IM call to us, where we can compare those call figures to your CSA data with all of your thresholds, minimum transfer amounts, and eligibility, make your margin calls for you and agree those, and then investigate where there are disputes and reconcile for trade and initial margin reconciliation. So that was a very speedy response tour, but I think we have literally a few minutes to take questions. So I will now just have a look at some of the questions. So there's a few that have come in. I know that, Liam, you had one that came in around back and stress testing. Will there be a requirement for phases 5 and 6? I don't know if you want to take that one just in the last few minutes.
Yeah, thanks, Trevor. So there's been a couple of themes of questions coming through, actually, just while you were going through your section there, Trevor. So one was back testing and benchmarking. The question was, will this be required of firms in phase 5 and phase 6? So the answer is that the current regulatory position is that the regulators for the US have provided relief for buy-side firms, so that back testing is no longer a mandated regulatory requirement. It is currently still a regulatory requirement in Europe, but it is expected, highly anticipated, that there will be an announcement in January that will align with the US and provide relief for buy-side firms in Europe as well. So that will mean that essentially buy-side firms in the US and Europe will not have to do back testing as an obligation. Canada and Australia, I believe, still have the requirement, so hopefully they will also provide equivalent relief going forward. However, that doesn't take away from the recommendation is that buy-side firms do still do some form of their own back testing of the SIM model. Two reasons. One, partly to validate that the SIM model is appropriate for their portfolios. SIM is an industry-wide generalized model, and therefore it is not always, not always suitable for every type of trading portfolio. The other reason to do it is to give you a checkpoint against your dealers, such that if the eventuality occurs where your portfolio fails your dealer's back test and they have to increase the margin, that you have a control point where you can validate that. I'll just pick up one other thread, Trevor, because we had quite a number of questions coming through in the last few minutes on the $50 million threshold. I mentioned it and you expanded on that a bit, but just to quickly recap the questions that were coming through. The $50 million threshold is an entirely separate thing from the 50 billion ANA threshold. The two are entirely independent. The $50 million or 50 equivalent currency threshold is the level at which is the maximum level at which you have to start posting collateral. So if your IM requirement on your legal agreement is below that 50 million threshold, then you do not, by UMR rules, have to post collateral. You do still have to have an eligible CSA in place, But if you're sure that you are going to be below the threshold, you do not have to have the custodian agreements and all the other pieces in place, and Trevor was talking to there. And the other point, as we've both sort of talked, that 50 million could be lower. It's dependent upon your agreement, and it also, the overall threshold applies at the overall group relationship level. So if you have multiple legal agreements between affiliates of your group and, say, affiliates of UBS or any other bank, the 50 million applies at the top level.
Okay. I appreciate we're just at time. I just had one quick last question, which was how is the 2.2 version of the SIM different to the previous version? And I don't know, David, whether you can pick that one up.
Yeah, sure. So the model is constantly being tested, and so the parameters of the model are being adjusted every new version. So you can expect that every year you will have a new version. The model is standardized, so at the end, the difference, if you have a different number than your counterparty, is going to come or from the market data, or from the analytics, or from the mapping of the CSA. And that's really, what we do. So at ICE for the market data and analytics, at SmartStream for the mapping of the CSA, what we do is to provide really some data and some technology to make sure that all the boxes are ticked. So the model is producing exactly the same number, and then everything can be automated and streamlined. So that's really how we can conclude. Maybe I want to take this opportunity to thank everyone for joining today's session. I want to thank Liam and Trevor as well for doing this presentation today with us. And you have our contact details, our email addresses. Feel free to reach out to us if you need more information about this topic. Thank you very much.
Thank you. And once again, this does conclude today's webinar. And at this time, you may now disconnect. Have a great day.